So was there a deal or mentor or even a mistake that really set you up for this career in the private credit or you're doing some real estate as well?
Yeah, I'll tell you what it is. It was desperation at the age of 21, 22, coming out of college, not knowing what to do. All your friends are getting jobs. You're like, what am I going to do? I thought I wanted to go into medicine. You're being totally shot down. But meeting with this one guy who de facto became a mentor, which was the brother who worked at Goldman Sachs, who was the brother of the surgeon who I was working for. He told me everything, and he said, "Look, my brother's a surgeon there. He's a service provider. Okay, he makes money. He makes a lot of money. He makes $1 million a year, but that's not a lot. This was like 30 years ago, right? When I was like, different than it is today." And he said, if you want to work with me, you have to understand that you're in sales, right? And you are constantly talking to people, and your relationship is a function of your reputation.
Welcome back to the Wealth Vibe Show, where we talk about creating, protecting, and expanding wealth spiritually, mentally, and financially. But today, we are going into a world most people never get to see how the 0.001% invest, and just as important, what they stay away from. My guest works directly with some of the world's wealthiest families, the 0.001%. He sees firsthand what they're investing in, and just as importantly, what they won't touch. Salvatore Buscemi is the CEO and co-founding partner of Brahmin Partners, a private multifamily office with a portfolio that includes names like SpaceX, Stripe, and Thrive Bioscience. He is also the author of 3 influential books on raising capital and investing psychology. And he's been featured everywhere from Forbes to Business Insider. Sal, welcome to the Wealth Vibe Show. I'm super excited to have you with me today.
It's been a while. It's a pleasure and a privilege, Vinky. Thank you.
And like I mentioned, today our topic is inside the vault, where the
Mhm.
0.001% put their money and where they don't. That's what we're going to be talking about today. So
Mhm.
we are looking at how the richest families in the world invest. You will hear what the 0.001% are putting their money into and what they are staying away from. So Sal, I'm going to start with this question. Before we get into the 0.001% that these wealthy families are doing today, let's rewind a little bit and wanted to hear about your journey. How did your journey in investing begin, and what early experiences shaped the way you think about money and risk?
Wow, that's a long question. I'll tell you that I was starting out going into med school, Vinky, but I didn't go to med school because I was doing an internship between my junior and senior year of college. And I was working with one of the most prominent orthopedic surgeons in New York City who performed surgeries and helped the New York Knicks and all these sports teams. It was called the Insel Scott Kelly Institute for Total Knee Reconstruction. And everything was going really well until I was doing some research and I was in the cadaver room, Vinky, and I passed out holding a tibula where I saw the ball and everything.
Mhm.
And the doctor I was working with, Johns Hopkins trained doctor, was championing me, and he gave me smelling salts, but I felt very embarrassed. And I think at that point, it started to make the decision to myself that I could not go into medicine, and a PhD program is not for me. I don't know where you go from there. Um, and again, we've seeded a lot of PhDs in my career in life sciences. So I called him after the summer and he said, look, Sal, you gave me great work. You're a great student. I wish you the best. However, I've been talking to my brother about you. He just made partner at Goldman Sachs and he wants to talk to you. And then the rest is history. And I wrote about that in my book. Any viewer that's listening to this wants a free copy, I will give them an opportunity to email me later and I'll ship out a free autographed copy to anyone who wants Vinky on that. But it really talks about at this point when you're talking about finance. And finance is, besides diabetes, the biggest export of the United States. We're a nation of merchants. And when you learn the inner structures of finance and how it works, you find out that it's much different than what your middle class brothers and sisters look at it, right? And the difference is because the wealthy are already rich, whereas the middle class are not rich. They probably will never be rich. But and it's not their fault. It's just, with inflation and savings and making an income, it's just not, that's not the same way as looking at someone who is worth over $100 million. A lot of people say I say the 0.001%, that's 1,000th of 1% of the families in the world. This could be anyone who you can think of, maybe Armancio Ortega. You've heard of Zara, right? Are you wearing
Mm-hmm.
Zara now? Okay. 1.3 billion funneled into free and clear real estate, class A, office, industrial around the world. And that's the same thing that we do, is invest on behalf of these wealth creators. They have companies that throw off a lot of cash. They're operating companies, and they need to put it somewhere. And we have 13 families all over 100 million that we work with. And the true definition of a family office is, I think it's changed, but I say at least $100 million. I think people go to conferences and they say they're a family office, and the guy's wearing you just know. You can tell right away, just looking at them and their pedigree. And so we do a very good job of managing it. We are very protective of our track record. We only go into Class A assets. We do not invest in first-time founders. We like to have founders, as I said before, who have had multiple exits. We have one company, Thrive Bioscience, which you talked about earlier today. Thrive Bioscience is going to be the founder's 17th exit and 8th unicorn. That's what I like. And it's all funded by fellow in-kind family offices that understand life sciences and have made their wealth in in-kind industries, if that makes sense. And we like doing that. We have lots of wins. There's some stories that aren't that great, where we've lost money on one deal over the past 10 years. It's not bad. But we stick to our pudding. We eat our pudding. We stick to our rules as it relates to what we invest into. We don't deviate from that. And I think today, a lot of middle-class investors and people who want to get into like private direct venture investing, they don't know what they're doing. And there's actually more people today, I think, with single purpose LLCs raising money for their own companies than there are shares of publicly traded stocks on both the NYSE and the NASDAQ. And, you got to look at it this way. America is a land of opportunity, especially now. We're starting to see a lot of money come in from overseas, a lot of people come in for overseas. I live in Miami, and everybody has their tin cup out raising money for something, right? That necessarily means that works. But even it's the same hustler in Silicon Valley today and in Palo Alto. So we're very protective of our track record, and we build the relationships to be long-term. We're not looking to be the biggest guys in the room, just the most successful.
Thank you for that. That was a long introduction. I love that, every word of it, and do have tons of follow-up questions. But before that, I wanted to ask you, was there a defining moment for you? Because you shifted from med to finance, right? So was there a deal or mentor or even a mistake that really set you up for this career in the private credit, or you're doing some real estate as well?
Yeah, I'll tell you what it is. It was desperation at the age of 21, 22, coming out of college, not knowing what to do. All your friends are getting jobs. You're like, what am I going to do? I thought I wanted to go into medicine. You're totally shot down. But meeting with this one guy who de facto became a mentor, which was the brother who worked at Goldman Sachs, who was the brother of the surgeon who I was working for, he told me everything. And he said, look, my brother's a surgeon there. He's a service provider. Okay. He makes money. He makes a lot of money. He makes $1 million a year, but that's not a lot. This is like, 30 years ago, right? When I was different than it is today. And he said, if you want to work with me, you have to understand that you're in sales, right? And you are constantly talking to people, and your relationship is a function of your reputation. And from then on, there's a lot of lessons that went on it, but it wasn't anything else. I was in the investment banking division at the group. I worked on a lot of interesting things. And then when my father passed away at 24, I made a concerted effort to promise myself that I would do something entrepreneurial before the age of 30 at Loomba. And what that is that I said I wanted to start a fund, and I did. And at the age of 29, I raised $30 million from a Park Avenue investment manager. And we basically ate everything from Bear Stearns, right? They were going under. We saw this happening. It was the time to strike. And that's what we did. And we made in and did the moves. And then we did it again out west. But for now, we just allocators. We don't own anything. I don't knock tin. I don't deal with contractors. I don't deal with any of that. We just provide equity capital on behalf of our families and ourselves into these deals. It's also my partner in our capital too that we invest in this. So if we're going into it, other people want to get into it because if we're putting our money into it, chances are there's a good story there. They're going to meet some interesting people, and it's all about the networking too.
I love that. We allocate capital. That's awesome.
That's all I am. Like that's
That's awesome.
these hands don't have calluses from like knocking tin or anything. Right, Vinky? No, that's it. That's all I do.
So I wanted to go back when you were 30 and you raised 30 million. Share with us that
29,
experience.
yeah, 29.
29,
So
29,
yeah,
you're 30 million. So what was that experience like? That was first time and raising that much.
humbling, humbling.
Humbling.
Very, 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 very humbling. And a lot of people, I must have had the door slammed on my face on Park Avenue at least 30 times, right? And really, it wasn't so much with me. It was a belief that you couldn't short the U.S. housing market. Well, there's been movies written about that. We didn't do any of that stuff that's in the movie Big Short. I just want to be clear. We were just buying defaulted loans for like literally 5, 10 cents on the dollar and reselling them to other participants. And it worked out really, really well. But one of the things is that I learned is that you need to be persistent and build relationships with these people. I think too many times people come in and they're like, hey, it's like it's like going into a restaurant for the first time. You never see them again. And I'm like, how do you build a relationship with someone? Like you have a whole thesis and a plan that took you a month to put together this beautiful deck, and you're not going back to all the other people to update them on everything that's going on. Like they sort of owe you an obligation because they've already given you their time. And it was through that persistence of just making sure that I was communicating with these people, even articles that supported my fact or something that really made it different. Because I think a lot of people, and to be honest, they go in with egos thinking that their idea is the best. But I went in very humbled because I didn't want people to think that. I was also a first-time emerging manager, so I had a few red I wouldn't say red flags, but first-time fund managers, especially when you're younger, you might be looked at kind of funny. But I was able to get away with it because I had great experience and great people I was surrounding myself with.
Mm-hmm. And today you sit at the table with some of the wealthiest families in the world. So that's not an easy circle to break into. What does
Yeah.
it really take to earn that trust of those families at that level?
I provide too much value first to them if I'm meeting someone, and not all of them do this, but you got to look at this. And I don't mean this to sound creepy, but you have to look at these families that you're building a relationship with, that you're courting them for marriage. Because if you're courting them for money, you're courting them for something over the long term. Does that make sense? Like there are investors who are in our deals for 5, 10 years, almost 10 years right now. We're married to those investors. And I think investors, especially families, are more sophisticated. And they're going to be looking at you and being like, does this guy really have the discretion to really, is he really using me for a check, or is he going to protect my family name? And I think that today is what it is. These are relationships that come out of circles and introductions through things that we've done in the past. We're actually going to be expanding, even though we don't want to be the biggest. We'll probably have 20 families by the end of the year, only because we haven't done any real estate in a while. We've been doing a lot of life sciences. We've had some exits. We've been in SpaceX 5 times. We're going in a 6th time. We'll be going into Neuralink. We did Stripe, the payment processor. We invested in that 3 times already. And right now we're going into Class A real estate. That's it. Class A industrial is what I like. And when you talk to these families, you got to treat them like you're friends. And I think too many people are just awkward around wealthy people. They don't know how to act. They don't know how to use them as friends. And, it's sort of like a junior high school dance. They don't know how to ask. All the girls are on one side, the boys are on the other, right? And that's just, all right. And that's just, the way I see it. But, it takes a lot. But it also takes a tremendous, and it also comes from relationships. And every family that I know has come from a relationship. You got to meet Sal. He's fun. He's great. He's a crazy guy in Miami. He's a real estate guy. He's in SpaceX, whatever. They want to meet you. And the first thing I always say is, how can I help you? What are you working on? And everybody's got a problem. I don't care how rich you are.
That's
Sometimes
true.
it's getting into like a school. Sometimes it's, I people who have helped, my partners help people do that. Sometimes, like a prestigious, private school, or just anything as relates to like maybe tax help or something. I wouldn't say like they need an accountant, but just, they have like a tax question or something, you know who to refer them to, you know how to refer them to. And
Connected.
it comes down to, really, if you want to do this quickly, it's just building a great reputation for yourself. And then providing value by power brokering, right? Like, hey, I don't know you. You're probably not going to invest in any of my deals, but I want to help you. And sure enough, that comes around full circle. It's like, and I call this one guy. It's like, hey, I know this isn't for you, but I need $1 million, by the end of the month to close, to close on a SpaceX round. No problem, I got it. And that's the highest. That's the highest compliment anyone can give you is by making a referral to you in kind. Does that make sense?
It does. And it's very important to get to that level, having that kind of understanding, first of all, how to build relationship for somebody. Like you mentioned earlier, very funny thing. You said middle class will never be rich, right? Because it's a
No.
mentality, because there's so many blocks, right? The money blocks, the way they treat money, they don't look at it as an energy. I mean, it's like kind of on the hoarding mindset, totally different mindset, compared to the ultra wealthy people. So I wanted to learn from your experience. Go ahead.
Yeah. No, you bring up a good point. Everybody who you're talking about right now is is somehow a legacy of the Great Depression. And they
Mhm.
learned everything from their parents who came over. Maybe they weren't, but people who, immigrants were especially hard hit. There was not a lot of jobs or anything. And they remember seeing the pain that their parents went through. And so
Mhm.
they were always like, hoard, 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 money, money, money. You fast forward to 1971, what happened? The value of the dollar just continued to go down, down, down. And it has been ever since. And that's why we're starting to look at, I'm not going to go off on tangents like going into stablecoin or anything like that. But at some point, all of these people are losing out because they have a scarcity mentality, if that makes sense, where they hoard their money because they can't make money. They are capped at their income. If you're making $200,000 a year as a dentist or a doctor, that's it. That's it. That's all you're gonna get. After taxes, you'll probably lose more, depending on like AI and how much they're gonna put. They're going to burden you humanly with multiple caseloads, or even as a lawyer, caseloads too, as it relates to that. These people will never be able to have the time to network to get to the wealth that they want, and that's why they all gravitate towards get rich quick things such as crypto, meme stocks. You know what I'm talking about?
Yeah, but the thing is, even they get rich quickly, still the mindset is still there. So I wanted to learn from your experience,
Yeah,
how did you get that mindset? Were you born in a
yeah.
rich family and you kind of, had that mindset from the very get-go? Or is there something, there was some shift happen and
Yeah,
you
it's
go ahead.
interesting. Yeah, so when I was growing up, I had a lawn care business that I was working on, and my dad used to make me put all the money. I was good at it. I was a good salesman, and
Mhm.
I liked money. Okay, and he would always make me invest in Series double E savings bonds, right?
Nice.
And all those, and it was great because at the time when Goldman Sachs went public, when I was there, I was able to buy up a few more shares, and it worked out well. But one of the things I learned about my father is that he was a PhD, he was a chemistry professor, and what happened is that he had friends, and people learn from friends who they think they know. But one of the things he learned was the way he put my brother and I through college without having to taken any student loans, and again, this would probably never happen today, is that he would invest that money into like treasuries and zero coupon bonds, right? That were actually paying, at the time when I was born in 75. So,
Mhm.
in the 70s, higher interest rates, and, that helped a lot. And it was really that mentality of having the assets pay for the cars and things like that that really came into existence. He did it very well, very carefully at a good retail level, and was able to, achieve a lot of wealth for that, doing that stuff. But he was able also to be able to use the assets to pay for things that most middle class people would never do that because they're too busy and their egos are too shallow. They want to get in and out and show everybody how smart they are by getting into this stock and this and everything like that. They want the win. They want to be respected, but nobody really respects day traders, right? So it's 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 a different world today, than it was, and it's mostly because it's inflation driven. But when you look at the people, the real benchmark for people who change their attitudes is they finally feel secure enough wealth wise when they hit 100 million. It becomes an entirely different construct.
Mhm.
Anything less than that, we have a term in the industry for, and it's called NREs, not rich enoughs. And so these are like 5 to 10 million, but they still got that Chicken Little syndrome, you know what I mean? And they still are swinging for the fences, and they're not there enough. They still want more, more, more. But what they do is they, sort of risk it on assets that they have no control of. Whereas the wealthy have businesses that they've even sold or businesses that they operate that draw cash flow. And that to them causes much more of an issue than to someone who else is middle class. If you have a business that's throwing off free cash flow of $2 million a month, you have a problem. Okay, you have a problem, and that's why most of them gravitate towards our real estate holdings. If you're $200,000 a year and you made 20,000 in crypto, there's nothing I can do with you, right? And I think people are just going to continue to think smaller and smaller and smaller. But there's also a tremendous amount of pressure in the industry too, because what was it, like early 2000s after the .com? Now you have Jim Cramer that turned day trading into the WWF, so it's like a wrestling ring, right?
I know.
And that, yeah, so like, so, but he added a lot of, of that and the energy that comes into it, but that's not long-term energy. Wealthy families I know, they're not sitting on, $20 million worth of Google stock or anything. It's they don't do that. They go into private direct investments where they can have much more control and discretion, and also, raise a status and identity too.
Yeah, I think let's dig a little bit deeper more for the middle class families who are
Yeah.
not the $100 million threshold yet, because I think it's a vicious cycle for them because they're in the survival mode. Most of the time,
They'll always be in
they're
survival
always in
mode.
the survival mode. That's what you're talking about, the scarcity mindset, right? So
NREs, not rich enough. Yep.
exactly. So it's just like in that, how do you break that cycle? If you're in that cycle, even you have 100 million, you're gonna be still there unless you break that mental block, and start spending like rich or talking like rich or thinking like ultra wealthy rich. You're not going to be investing in the right places to generate enough. It's going to more like still that mental block. Okay, hold on to it, I might lose it. That risk appetite hasn't grown with you. So share with us your experience, how somebody can break those.
Very good question. The wealth creators, meaning someone who's made a lot of money, but not a lot of, let's just say between $5 and $10 million, they are still looking for the next grab, right? They're still looking to go up and next. They're never going to be happy with it. The problem is that this is also the demographic which caters to Rolls Royce, Rolex, expensive vacations. They'd rather show and flaunt their wealth. In this American, we're a nation of consumers and merchants. Historically, this is the way it's been. We invented the credit card and retail leverage as we see it today. And until they get those yayas out of their system, they're not going to change.
Mm-hmm.
It's only at that point where they don't care and they really will invest into things that their friends can't see to really determine if they're going to move out or not. Case in point, there's this one guy, he's like, I don't know, I can't find any good investments. I'm like, you just bought a nice, Porsche Cayenne for your girlfriend there. And I said, and I hope you don't mind me saying this, I'm like, if you really, really care about your future, you'll pay $5,000 and join me at this conference, per ticket and meet people. Otherwise, nobody's ever going to take you seriously.
That's true.
And at that point, he went home. He's like, 5,000. I'm like, 5,000 is a lot of money for you. I'm like, how much is your reputation worth? You're going to lose all this money because you're going to be putting it down the drain, following people because you don't have a network. You don't have a network of people. People are too siloed in their jobs. If you're doctors and dentists, they only know people there and they only take financial advice from people in those silos because they're too scared to go out to a conference. I spent $25,000 on a ticket to go to the Milken conference in LA for a couple of years. Up until recently. And the reason is because the network was just incredible. I want to be in the room with those people. If you're sitting on $5 million, you best be in a room with people smarter and wealthier than you.
Yeah, I agree on that. But I think I'm going to take your friend's example, like you were talking about, spend money to go to the conference. For somebody like the first timer or maybe second timer or 10th timer, if they do not know how to move in that circle, or mingle with the people around them, what kind of advice would you give them? Because, people get intimidated by the wealth or by the amount of money or people's persona or their aura is different too of these people, So like you mentioned earlier, another funny thing you said, when you see people have their family office back their name and then when they walk into this family office clubs or conferences, you can spot them right away. So what is that differentiator for them? So if you can
Yeah.
start with that.
Okay. That's two separate questions, and I'm going to answer the
Exactly.
yeah. The first one is, if you these conferences are not like they're meant to be able, they're very well, a lot of the ones that are higher end are curated for a lot of like um networking. There's always after hour parties, there's always networking. And one of the things I would do is, if I was just sitting there and I was just, and I've done this before, I just like to go to the conference and meet people and ask them questions. That's it. I ask them questions. What do find out? Oh, this is great. I'd love to follow up with you. You know,
Mm,
how would you like a copy of my book? For example, like things like that, things like that. But I think what you want to do is, you want to be able to build relationships with people legitimately by asking them questions and then saying, look, I have a situation. I just came into some money. I don't really trust a lot of people. You don't have to say it that way, but what are people doing today to invest in real estate with, 5 million, $10 million in assets? And I think at that point, if you really care about your legacy, you really care about what your kids and grandkids will say about you after you pass, you have to invest in building a network today. One thing that's happened since the pandemic and AI is that people today are very scared of, I wouldn't say scared, but the defenses are up because they always have like, they always think they're being sold or talking to a chatbot, right? And if
mhm.
you're able to show that you're legitimate, organic, human, yeah, you're going to attract a lot of attention. And there's also a tailwind at your back too, is because since the pandemic, there's been I think a loneliness epidemic, and that's contributed a lot. And people are just looking for the authenticity of good relationships, and call these people, ask them questions, give them a lot of value, and before you know it, you're involved in things you never thought you'd be involved in. I'd like to share a story about this. In my book, chapter 5, I met a guy who is, his father built Wacker Drive in Chicago by being a very good equity allocator in the 60s and 50s, right? He didn't build it, but all those, beautiful, shiny office buildings he wrote. His name is Richard Walken. And he calls me one day and he has the most authoritative Chicago accent you'll ever hear. Son of his father. He's like, Sal, you got to invest in the company. You got to invest in this company. You got to invest. Okay. Only because I trusted him did I invest in his company. That was 3 years ago in a hot August. We were able to get $1 million into a company behind a very prominent family office called Raptor, which
Mhm.
is a private equity firm of a very prominent sports team owner. 3 years, almost 3 years later, I get a phone call that the Saudi PIF, Saudi Investment Fund, had invested 50 million, or they have closed $50 million into this investment, and that made my investors feel very, very, very happy to do that.
Wow.
And I was able to do that through the relationships that I had to do that and to bring it together. If I was not trusted, and again with the middle class, nobody trusts them. It might be good, but like if you're talking to a guy like me, I'm going to tell you yes or no, right? Then get like, yeah, I like, no, I don't, but I know a guy or girl that might, right? Middle class will just ghost you. They want to be taken seriously. They want to feel as though they're richer than they actually are, but they don't write the check and they ghost you. And really, the difference between this is, and these two levels is, you can't. I don't want to get you canceled. You can't trust the middle class. Okay, you can't. Everybody knows that, but you can trust a very wealthy investor with his reputation to tell you certain things. And if he's putting money into it, maybe you should too, or at least look at it. Does that make sense?
Yeah, it does. So what I'm hearing is, I think the main gap is right there. You think the middle class are not resourceful enough. And that's the biggest gap right there. And people don't even realize that I'm not resource enough. They just like, I think they're just like very kind of blindsided, like they have the blinders on, just focusing on one thing only and not growing wide. I'm not sure if they're deep enough as
No,
well.
it's true. It's
Yeah,
true. It's
yeah.
true.
And then I think when you move on to the ultra rich families, they are very, very deep. Their roots are very, very grounded, very, very deep. At the same time, they are kind of widespread. Their network is so big. And then the sooner you learn that in your life, the better for you, more successful.
I Yeah, and for me, like I'll be honest with you, I get pitched a lot. I don't
Uh-huh.
want anything that I see. I
Mhm.
get what I want. Does that make sense? Because of the relationships and the trust that we have. My partner and I over the past 10, 20 years doing this with people.
Mhm.
They know, I'll tell them, no, I can't. I could have told that guy easily, you know what, I'm in East Hampton. I'm having a good time right now, Rich. Why don't we talk about this after Labor Day? Because I knew if I waited until after Labor Day, it'd be gone. And then I wouldn't be able to have anything to talk about. I wouldn't be able to have this company. sort of like another trophy on the shelf, so to speak, investing in these types of situations. And that's something that, you got to be resourceful. If you really want to do this, you have to make an effort to do something. And it to me, it is no different than anyone else who is pre-diabetic, right? People who are pre-diabetic, they can fix it or they can't, right? You can either
Right.
fix it or you can't, right? It's not cancer, thankfully, but you can fix it or you can't. And people don't fix it because they just, there's always an excuse. Well, I got to talk to my spouse, and we got to. That's fine. Maybe you're not rich enough to be able to get into these levels. Maybe it's just not for you. But at that point, the only way you're going to break through is if you continue to network with people. I can tell you, every family that I have, that I speak to, they have for lack of a better term, they have like an impact statement, or they have some sort of a mandate that they follow, right? So they stick with the mandate, and as long as you fit into the mandate, it works. I think where a lot of people today, they try to do things where they try to maybe approach people with things that they shouldn't be doing because everybody can smell on the other end that they're trying to make a quick buck, right?
I agree on that. Yeah, I know. Yeah, so let's shift gears here a little bit
Yeah,
and
yeah, yeah.
talk about how they invest. We hear
Mm-hmm.
headlines about billionaires investing in space or tech, but behind closed doors, what are the actual opportunities these families are most
Yeah.
drawn to right now? We were talking about crypto earlier as well. So if you can plug that in, that'll be the right time.
Yeah. Crypto, for most in the institutional world, is the cocaine of the investment world. It's not anything, there's only a small amount of people that control it. It
Mm-hmm.
really doesn't have any value. It's great, people. But if you look at the people who gravitate towards it, they're usually basement dwellers who didn't really pass math class in high school. And I saw this in Miami after the pandemic when you had all of these kids with suitcases full of cash just going to clubs and, cranking up $15,000 bar bills. Like, you'll never see that. That's not their money. They'll never see that again. Does that make sense? It's just a flash in the pan.
Right.
What today people are looking at, mostly families, they're looking at 40 years out. Okay. That doesn't mean sitting in their 401k. I know one family that's a multi-billion-dollar family, and they're actively buying. They're looking for EBITDA 40 years from now in 2065. Okay.
Mhm.
How do you do that? Well, what they're doing is they're buying grease trap cleaning businesses and rolling them up. Right? I mean, this is what they're doing. Are they
Uh-huh.
going into the Magnificent Seven? No. I mean, they have no control over that, right? I mean, the stock market is for people who can't create their own wealth. That's why they invented it. Put it in here and let the stock market and Warren Buffett take care of the rest. And that's the way it's been, since, post World War II, since post World War II, we've had tremendous amount of, success that way. And America will always be a safe place for very, very wealthy people to invest. But what they're going into today are mostly things that will improve their legacy and longevity. What they also improve into are things that sort of extend their status. Sports teams. Okay, everybody. Sports teams are very hard to get into. We might be doing one early next year. Through some of the friends that I mentioned and people mentioned in the book, because I have that reputation, I do see certain things. But they like that. Not only is it a store of wealth, right? But there's exclusivity there. I mean, it's more exclusive than a New York City condo board. And, God forbid anything bad comes up, in a Google search of you doing anything inappropriate, they're not going to let you in to this. But that is like, to them, if you own a sports team, that is a glory. And that's the way it is in London. In London, they knight you. In America, they allow you to buy a professional sports team.
Mhm. Awesome. And how about real estate or any philanthropic
Yeah,
efforts?
real estate philanthropic is. I have a story on that one. How we got into life sciences. I'll get into that in a second. Real estate, Class A real estate. That's it, Class A. They want to be able to see. This is. They don't want. They're already rich. They're not looking for Class C to Class B value added deal where a lot of good things need to happen before somebody gets paid. Right. They want certainty of execution, mostly what we call like core assets, which is great. As philanthropy is interesting, that causes a lot of friction in the families because it comes with a tremendous amount of emotion. I can tell
Uh-huh.
you, 10 years ago, when I was getting outbid on a lot of on a lot of real estate assets because of interest rates were going down, I was like, I'm not gonna participate on this, and I wound up having to give back about $30 million.
Mhm.
And what I started doing is pivoting into life sciences and other things. And one of the things that I had was, there's a lot of people, a lot of real estate family offices that I knew who were big, worth their salt, Vinky, will all have a gateway to life sciences, and that's through philanthropy. And when you could show them that instead of the philanthropy, where has very high material expense ratios, you see Susan Komen on TV wearing gold and diamonds and everything. People get a little worried about that. Where's that money really going? How much did they pay Kim Kardashian, the Tunnel to Towers guy, right? I mean, that guy makes $1 million a year. People are kind of disgusted with that. And so when you show them that 100 cents on the dollar will go towards an intended recipient in this one company, and you're working with a CEO who you have on speed dial, that changes things differently. That adds a tremendous amount of discretion, but it allows them to sort of feel much more proud about it because they have much more hands-on and seeming discretion in the investment that they made rather than just throwing money. I don't know very many wealthy families that throw money at these charitable organizations. They're mostly middle-class people that do that with the bleeding hearts. But I can tell you, anytime that, if I would get into doing something like that, I'd want to look at that philanthropy in the same way of a balance sheet that I would look at any other company. And I think today, what I was able to do very cleverly was to reach into their investment pocket and their philanthropy pocket to go into world-class life science deals.
Yeah, I think it's kind of a business too. If you look at it, if it's not managed properly, it's not a true nonprofit either, because
Yeah.
most of the eaten at the higher level in the overhead costs, and very little goes to the initiative, anyways, to the main cause. So let me ask you this question. This is as powerful as the question that I asked you earlier, where people are investing. So I'm going to ask
Mhm.
what things they are staying away from, and
Yeah.
even when the mainstream is piling in. Because we see
Right now,
that when middle
yeah.
class people say Warren Buffett is investing in this particular stock, so everybody wants to ride that way
Yeah.
because this is in the news.
I don't see a lot of wealthier people over 100 million investing in stocks. I think they have like a small allocation into, the Magnificent Sevens, and they're active and they play with that and they know what they're doing. They are not going into they're not going into stock plays. They're not day trading. They're not going into crypto. They're not going into NFTs. They're not going into private credit right now. That's sort of run its course, I think, from a macroeconomic play. But they are, going into Class A real estate. I mean, land, real estate. That's what they want. There's a permanency with owning these assets that they like that the middle class doesn't. The middle class cannot stand and is allergic to anything illiquid.
Yeah, that's a big question too, right? Because they want more liquidity. So let's talk about that too a little bit. What is that
Ah,
mindset behind it,
nobody.
the
If
liquidity and
you're,
the liquid?
yeah, I wrote about this. Liquidity is a myth, right?
It
Because
is.
if you don't need it, why do you why do you need to have it?
Yeah, but
And I
it's just
think
a mindset around it, right? Thinking that, oh, I have, $10,000 or $100,000 sitting in the bank. If I need it, I can withdraw. But they don't realize that they're missing the opportunity. It's a missed opportunity if the money is sitting in the bank
it sucks for
without
them.
doing
I know it sucks for them, but you can't help them because they're stuck in their own, it, they're hoarding, right? They're hoarding. They don't know any better. They don't tell you that, but they're hoarding, right? And
it.
there's a lot of people that did have $10,000, $100,000 in their bank account, and then the pandemic came around and they didn't have anything left because they put it in crypto or NFTs, right? So I think it's just a mentality to them. It's like, oh, I need to get out in case I really need it. If you really need it, you should not be investing in anything private direct in the first place. You're just
Mhm.
not rich enough. I tell people, I'm like, you're not rich enough for this. Like, this is not for you. And I'd much rather do that than tell them, oh, come in and invest because that's just going to cause problems later. I'll just say, look, I don't know if this is, you're kind of like stretching this right now. I don't know if this is really going to work. Why don't we just look at the next deal? Okay, that's fine. You don't want to take someone's last bunch of money because to them, that's their security. And people get very, very, some people can't deal with financial insecurity. That's why, a lot of entrepreneurs basically burn out is because they just get tired of the business, right? They get tired and, and at some point they started because they weren't afraid of being illiquid. But the moment, if you have a job and you're involved in a career and you got kids and a family, I don't, it's going to take a tremendous amount of muscle to move your mentality to do something to take on risk. There's no such thing as a free lunch today. Not even the treasury bonds, but we can talk about that later. But there's no such thing as, a free lunch without taking risk. And I think a lot of people don't understand that because they have never really taken the time to really learn and get financially savvy as to what their richer brethren are working on. They're just following a wealth advisor who's reading off of a sushi menu of things they want to sell you at a Raymond James or a any other broker dealer. But yeah, I mean, I could tell you I could tell you stories that I write about in my book. I mean, there's this one very prominent second generation Asian family in Southern California, and he came up to me and he said, "Look, Sal, I don't want to sound awkward, but my parents and everything, and my dad died, and this guy now who's in charge of the account looks like he just got off the beach and he has a fading tribal tattoo underneath his short sleeve shirt, somewhere in Newport Beach." And I don't want to sound like a snot, but I know this guy did not work hard enough to accumulate the wealth that my first time immigrant family created when they moved here from Korea, right? To to defend their own businesses. This guy just looks like he doesn't give a crap. And that's when it started hitting to him, was like, do these guys really have any sort of alignment of interest with me to be able to invest in this? And when you look at it, most of these people are just realtors selling off the same sushi menu. If you don't like what's in my left pocket, you're going to love what's in my right pocket here. And that's, really it. It's just a menu that they sell off of.
Mm-hmm. So I'm going to ask
Very
you
interesting.
a follow-up question. Earlier, remember you mentioned that one of the family offices that you work with, they're looking into 40 years ahead of time, right? So most of us, we think in years. And then I think from your, whatever I'm gathering, seems like, the top 0.001% seem to think in decades, because you mentioned 40 years out, right? Even generations. So how does that long-term lens change the way they make their decisions?
Because they're no longer in survival mode.
That's true. Yeah, I agree.
That's it. They're no longer in survival mode. Now they're in prosper mode and I wouldn't say preservation, but grow in a way where it's much more meaningful. You don't when you have I don't know, 6 kids and then who knows how many grandkids you'll have. I mean, I'm just making these numbers up. You're gonna, if you have money coming in, you want to make sure that that is covered. Your responsibility becomes as part of your legacy. I can tell you, his kids and grandkids are going to be thinking and talking about him much differently post-mortem than most of your middle-class investors who are like, well, I love my dad, but he spent all this money on stuff and, he lost it all and, over-leveraged the house and tried to do all sorts of things, which is the American way of doing it. I mean, every American gets bumps and bruises by, trading or trying to do something investing-wise. But they're looking at it from the standpoint where they can afford to do it because that to them is a luxury. Maybe they have a building with a name written on the side of it, with their name written on the side of it. That's what they're really looking for. And that's really what America is coming into right now. Unfortunately, I think America has become a land of recreation worldwide and also a store of wealth. And as long as, America becomes and still maintains, I don't know where else it's going to go, a major store of wealth, we'll be okay.
I know we are out of time, but I want to ask you one more question before
yes,
we go to a rapid fire.
Yes.
Looking into your crystal ball, looking ahead, the life sciences, the industrial, real estate, frontier tech. I mean, we talk about so many different things. So what themes or sectors do you believe will define the next decade of wealth creation?
Battery technology. I mean, you're going to get specific here. Battery and energy. You cannot have a country today if you don't have energy, and we need much more energy production. Nuclear is coming on 4th generation. That is what I'm looking into, these nuclear, maybe uranium things. This is important. We've actually opened up one family, families are getting old and patriarchs are dying off. We're in the middle of looking at a mining deal for rare earths and things that this country needs today for batteries, right? So that's, the play we're looking for. Space exploration, of course, we like that through SpaceX. There's also various, in India now, although we didn't invest in these, there's a lot of rocket companies now that are just, they're not going as high as SpaceX, but they're doing sort of like the Amazon, next, going up to the next orbit, sort of like, they're not driving cross country, they're driving to your house from a warehouse, right? So you're going to start to see that happen. But I think in energy, is and I don't mean oil, but I mean power. You need power. It's power. You got to have electricity, and in order to do that, we have to do that. Europe is not doing that. I think they're going to fall by the wayside. I know of no one investing in Europe except for speculation on stocks. You're not seeing that in Russia, but I think power is where it's going to be today. And I don't know if you know this, but they're actually laying a lot of cable between New York City and Canada, because we're going to be getting a lot of power now to power New York City only from Canada. So, these AI data centers are going to take a lot of electricity, and I don't think you can have enough of it. But I think there will be a point where we'll be energy neutral at some point in 20 years, and I think that'll be a great thing. Robotics hasn't really gotten to where it should be. I do follow a lot of that stuff, but if you look at just the underlying themes, it all comes down to power and power storage, I think.
I agree on that, because everything needs a power. Even if you go into robotics or or the machine learning or this AI coming in, everybody's eating a lot of power. So
Oh yeah,
yeah, it's really good. So this moves us to a rapid fire round. So let's quickly ask you 5 questions. You
sure.
answer it in one word or one sentence only. Spontaneous
Hmm.
answer, whatever comes to your mind first. So the first question is, first investment you ever made?
It's out of stocks. First investment I ever made, I bought a investment condo in New York City on 45th and Second Avenue and rented it out to UN diplomats for about 3 years, and then sold it for $120,000 profit 3 years later.
Great. A
Mhm.
book you would give to every aspiring investor.
Say that again. A book?
You give to every aspiring investor.
A copy of my book if they want it. For free. All they have to do is email me, Sal at Investing Legacy. I would what I would do is I would stay away from the mainline news, financial news, and go into more different news, looking at that kind of stuff. As far as I think a lot of people know that, but as far as the books are concerned, my book is great. There's another one that comes to mind, which I think is really interesting, and it doesn't have much to do with an investor, but it's something that's a great business book, and it's older, and it's Ogilvy on advertising, but it's really a masterclass on running a business. And there's a lot of rules and laws in there that do fit with investing if you think about it.
Third question is, most overrated investment trend today.
Bitcoin.
But Bitcoin is going to go to $1 million. That's what I heard. I think
It could. Yeah, it could.
it will,
Yeah,
maybe 10 years down the road. I mean, it's going up anyways. But
I mean,
Ethereum is
over.
picking up too, yeah.
Did you say over or under?
Over $1 million?
No, no. I think it's over. I think crypto at some point. It's just. I don't. I think it's a speculative instrument, really. Regardless of where it goes, it has nothing of any value. Crypto is nothing more than a ledger item that you and I both agree on.
That's true. That's true. But it's just like still something there. And it's powerful at this point. I think it might be in the future years. That's going to be like kind of, I would say, futuristic phenomenon that people are not embracing, the average or middle class people, you would say. But at some point, that's going to be the mainstream, and then people have to adapt to
It's
it.
coming that way, and it's coming into its own, and especially with the institutional adoption, that's going to help. And you're seeing that with stablecoin in concert, that'll help, crypto. But remember, I don't. People are allowed to go into crypto today with their 401ks and IRAs. That's only because Wall Street never met a fee it didn't like, right? So they're just making products for the people who cater to that, who believe in that. For me and the people I run with, it's not for us.
So the next question is, most underrated wealth building strategy.
I have a very wealthy investor who wanted to know how I could what would be a good idea for his son to start a business. And I told him, buy a franchise and let him see what he does. And I think that's an underestimated wealth creation mechanism for people. Some franchises, high-end franchises, not a new franchise. Yeah, high, like McDonald's. Shaq, for example, he has a real family office because he's a real businessman. But he owns, I think, I don't know, don't quote me on this, but 20 Domino's pizzas or something. I mean, this is a store. I mean, that's fine. It's fine as long as you're not operating it. But it is, I think, an underestimated wealth creation mechanism right now.
I know somebody who owns, I think, 300 or 500 Jack in the Box. So it is a
That's a
wealth
lot.
strategy to
It
to some
is.
extent, yeah.
Hey, you know, I there's a day where I don't look at like a McDonald's, you know, advertisement franchise a little funny, you know, on my LinkedIn. You know, like, you know, because I get it and I understand it. But I don't, you know, it's also a function of time too, as well. How much time do you have? But I think, you know, if you really want to get into it, you know, the faster way for wealth creation is to leverage other people's money, which is what you and I do, or
That's true.
you build a business, right?
That's so true.
Yeah.
So last question, one word that defines wealth for you right now.
Reputation.
I like that. Wow,
Yeah.
this is such an awesome conversation, Sal. I know we are way, way over time, but I would love to have you back and then, continue this powerful conversation some other time. And
Yes.
you have given us a like really, really, I say really good peek into the family offices or ultra high net worth, how they operate,
Hmm.
and
Yeah.
also offering us your book. So at this point, can you tell us
Free
how people
autographed
can reach
copies.
out to you?
Yes.
Tell us how
Sal
people
at
can reach
yeah.
out to you.
You can send an email to Sal at investinglegacy.com, SAL at investinglegacy.com. It's also available on Audible. I don't have any free Audible codes, but it's cheap, it's free. I narrated myself. You'll really like it. And it's going to give you sort of the inside look on things, or the idiosyncrasies, biases that a lot of wealthy people have that go just beyond this, but other things too.
Wonderful. Thank you so much. And to our audience, I hope you take today's insight as a reminder that wealth isn't just about chasing trends, it's about discipline, alignment, and playing the long game. So stay inspired, stay intentional, and keep building your wealth vibe. Thanks again, Sal, and I'll see you
Thank
next time.
you.
Thanks for tuning in to the Wealth Vibe Show. If you enjoyed the episode, be sure to subscribe and leave us a 5-star review. And don't forget your free gift. Download the Busy Professional's Guide to Real Estate Investing at loombainvest.com. See you next time with another amazing guest and another powerful conversation.